Dave is one of the coolest, kindest, amazing bosses that I've ever had, actually. The one before I said he fired me, but I'm trying to make this one better. So, round of applause for Dave Miller, please.
Thank you, sir. Well, welcome. Today we are going to talk about a really exciting topic, and that is how you get money from people. So, I don't know if it's exciting, but we're going to have fun with it anyway. So, why are we talking about finance and investing, and why am I talking about it? So, one is we're in the money business, and I think we all deal with needing money, and we take other people's money and use it for our benefit. If you're not doing that, then great. If you have all the cash and you can fawn your own, that's awesome. But majority of the time, we're using other people's money in some form or fashion in our business. I'm talking about it today because people kept asking me this question. Well, we raise quite a bit of private money, which is different than raising bank money. And so we've done a lot of private money, and people will just ask, well, how do you do it? What about this? What about that? So I was asked to talk on this again. A couple years ago, we talked about SEC regulations and how you comply with those. We're not covering that as much, other than I would say make sure you do comply with your SEC regulations and make sure that you are, if you're taking investors in, make sure you know how to take them in and that you do that well. Hire an attorney. I'm not that. I am the CEO of SmartPay Rentals. I have been in the finance aspects of various businesses that I kind of just found out I like numbers. I like business. I like working with those numbers. And so that has kind of played out to here I am today as I'm the treasurer here at the NBSRA. So even when I step in here, they say, okay, do the numbers thing. So we're going to talk about numbers and talk about dollars. That's why we're here. We're mainly going to talk about the pros and cons. This isn't where we're saying one is better than the other, whether we get bank financing or whether we have private investors. They can be good and bad in different situations, and we just kind of want to weigh out those things. I am going to talk from experience for me. You may land at a different spot. You may want more private or less private, and that's okay. It isn't about following what I'm saying here and writing that down. This is exactly how we do it. It's more about gaining enough of knowledge so that we can use wisdom in the end. Number one would be to make sure you understand your financial landscape. It's not landscape, but anyway, there's a typo in my slides. So, I'm not even up there yet. There we go. Landscape. So it's like Lancaster. You just kind of rule through with the end there. But so understand your financial landscape and make sure that you are kind of in tune with whoever you're talking with. So if we look back at last week, you're going to want to make sure that you're in tune with, let's say, the interest rates and what the FDI or what the Federal Reserve did in changing interest rates last week. Kind of unexpectedly moved faster. And what does that mean? I don't know that you always know exactly how it's going to play out, because it'll have ramifications downstream of when they do things and move things around. I don't think we can play it all out and say, oh, now I know exactly what's going to happen in 9 months from now. But you want to understand what's going on. So for those of you who aren't aware, like the Federal Reserve did change the interest rate last week, but they changed it a little differently than what we were expecting. So they had been for months saying, yeah, we'll cut it another quarter, and then we might cut it another quarter before the end of the year. So we might drop up 0.5% by the end of the year. Yeah. And even all the kind of the the bets are coming in on who's doing what, and everybody's kind of playing that game. And all of a sudden, boom, they said in one meeting, they said, we're going to drop it 0.5% today. And so it jarred the financial world a little bit, because that's saying, oh, that's not just sticking to that same storyline. The story is changing. So make sure you're in tune with those things, know kind of what's going on. It looks like, well, interest rates might come down faster than what we thought. Well, what does that mean? Does that mean you need to lower your interest rates to your investors faster? Does it mean you need to take them up because you want to get more investors faster? I don't know what it means for you, but know that and keep your finger on the pulse of that. The other thing is keep your finger on the pulse when you're bringing in private investors. It's a little more on an individual basis, but you need to understand a bit what that investor or what those investors are doing and thinking. If you have a large investor and he keeps talking about buying that beach property or that vacation property, well, prepare yourself, because that might mean he's not renewing the next note when it comes around. So on the private, it's much more micro than on the macro scale of things when you're talking with the interest rates that banks are following. And know how to effectively communicate with these people on asking the questions. So I think it's also good to look at your banker, kind of learn what he wants you to understand. So if he's trying to train you on how to build, if he's trying to train you on what you should know about their understanding of their models, I'm going to break off of that a little bit and come back to that one, because we want to hit that on another note there. But so let's hit on pros and cons of bank versus private. So I would say this is more in the line of, are these things good or bad? No, that's not what we're looking at. We're just like, are they good in some situations or better in others? So probably the biggest one is a bank revolving line of credit. So this is something you would have with a bank that they've said, hey, you have a line of credit for $3 million. You can draw on that and put back from that anytime you want. That's common for businesses to be using revolving line of credits. They're great. They're great because your money can come in and it can go out instantly, overnight even. We have ways with those sweep accounts. We have sweep accounts where you got $5,000 sitting in your checking account at the end of the day, goes over and pays down the line of credit. Well, that means you're going to pay less interest over time. Is that interest rate different than others? Probably, but it's really convenient and it helps you manage those monies better. So very good pros in that side of things. What I've seen a lot of times is these people will, in the rent-to-own world, will run their businesses on just larger lines of credit. You can sometimes term things out. That's also good. That's a different model from that. But if you're continuing to just have this line of credit become larger and larger, now we have a larger line of credit. Well, a big con in this side of it is that you end up moving to positions that, or spots in the calendar that are going to have big moments. And that is the line of credit gets renewed on, say, June 30th. And the months before that can be very, they can have a lot of angst in here where you're going, are we going to be able to renew that line of credit? Can we increase it? Is the banker going to decrease it? So the big thing is come June 30th for that line of credit, let's say, and it can really depend on, sometimes it's something as simple as you call your banker, months ahead, and the banker just got back in and he had a bad round of golf, and you say, hey, can I renew my line of credit? Can we start talking about that? and he's just in a bad mood, and just the way his body language or the way he talks to you might be, well, yeah, I'll see what I can do. Now, he might have full intention is going to get you your line of credit in the end, but just how he talked to you that day, and because there's this huge chunk sitting there, this needs to be renewed, you're going to have angst in here where you're going, I don't know. You talk to your business partner, it's like, banker kind of cut me off. And that's not fun. That's one of the cons of working with these large lines of credit and always having these big moments. It's the beauty of banks. They will give you larger chunks at a time, but then the flip side is there can be pain points when it doesn't come together. So it's really a scenario of how many eggs do you want in one basket? So do you want to diversify your eggs and put them in different baskets? So even with a bank, you can diversify and you can term some stuff out and you can have a line of credit. So there's ways of doing that. The other way to diversify would be with private money. When you have smaller chunks from individual investors, now you're putting these things into different deadline. Now maybe something is due June 15th of this year, and then there's something else in August, but it might be $100,000 or $200,000 chunks instead of a $3 million big chunk right in the end. Well, now you have these things played out, and you don't have the same type of angst when you have someone call you and say, hey, I want my money back. I actually got a call last night in the hotel room. Somebody's like, hey, I don't want to renew that after all. He's been there for 3 years. We knew his deadline was coming up. It was $100,000. So I sent an email to accounting and say, pay back his principal and interest. His note's due. He's not renewing. It wasn't really eventful, because it was $100,000. It wasn't $3 million from one guy that all of a sudden is there. So that's what you can do by spacing these things over a period of time. It can lower your ease and allow you to be at a show and not have a phone call where you go, So the banks will tend to ask for a lot more when it comes to things outside of what you provide to an investor. So banks want to have third parties look at your things, so they'll ask you for your tax returns because someone else is verifying what you're saying. Banks aren't very trusting in just saying, oh, I'll just take you on your word and let's have a handshake and you're going to pay me back but it's not bad. I'm saying that's actually good in the sense that they make you look harder and dig deeper within your own financials and preparing documents. The investors are going to be much less scrutiny and more a trust-based relationship. So it'll be easier, but then there'll probably be smaller chunks. And I talked about where you land on this, and I think a lot of people, well, let's say, how many people have both investors and bank money of some type? Investors and bank money. How many people have just investors, no bank money? And how many people have just banks? There wasn't near enough of hands. There wasn't near enough of hands up on that. I feel like there's some people missing. So there's a variety of these where you land on this is, are you using all bank or are you using all investors or are you somewhere in between there? And this is where I'm saying is it doesn't matter where you land. I'm not here to tell you where to land in there, but you can use this information to figure out where you want to land. And our experience was years back, we would have had the mentality that private is what we're using. We had a little bit of a line of credit and we're gonna build this up with private. But we had the mindset that we're using private till we can get more bank money. It was like kind of the crutch forward. Yeah, it's always nice. There's some of it there, but the big boys all are going to be going to the banks, and that's where we want to go with that. And as we were working through the hurdles of the banks it's kind of easy for a bank to first start off by, a bank might give you, a certain line of credit just kind of based on you and your relationship with the bank. But then as you start to grow, they want to look at the business a little bit more, and they're not always sure, where to, how much weight to put onto the finances of the business. So for us, as we were kind of breaking through, we were getting larger, and we really wanted to break into larger bank loans or a larger line of credit with the bank. And we had started interviewing different banks. They were very interested. We were looking for like a $10 million line of credit. And we're showing them on our balance sheet that we have $15 million of sheds that are sitting there, and they're getting excited. They're actually, they're leaning in and going, "Oh, do you have liens on these?" Well, we would show that we had private investors, but they have secondary liens, and so these liens, these are free and clear assets. Makes a bank very happy. So they're leaning in the table, and we're getting excited until they said, "So you have $10 million of or $15 million worth of inventory, free and clear, ready to go?" Yep. And they're like, "Well, where do you keep the inventory?" And we had to tell them that we have 3,000 addresses that our inventory is at. And now there's a shift. Now they're going, "Well, that doesn't fit any mold that we're not used to seeing this." Many times we talk about a large business and they've got piles of lumber, and they can go out and say, yep, I see your lumber. Now we're saying, here's 3,000 addresses. Different story. Now, even in that conversation, we ended up sitting there and explaining to them how the model works. Everything's good. They started to understand it. So the banker's going, "Yeah, well, this makes sense. But eventually he goes back and he has to report to someone else, which I'm guessing he had the same questions. They're like, "Well, hey, how does this work?" Like it was kind of an oddity. In the end, we ended up not going with that bank, not getting that line of credit, and getting caught flat-footed or leaning in one direction pretty heavily, where we hadn't been bringing in as much private money as because we thought, hey, this is what's going to happen next. And we got caught in a position where we ended up putting more money in ourselves to make sure, because what's the one thing you can't do as a money company? You can't run out of money. And it would have been detrimental for us to run out of money. So we had to, feed this thing, get this thing rolling. But I'm telling that experience just to say this is why we landed where we do today. It shaped us. So we, after that point, said we are going to take more private money. We still use bank lines of credits and so forth to manage money and to manage them well. But we have started using and relying more and being okay with saying we're going to go and do more private money. Now, it also means that we have to learn how to talk to investors differently than what we talk to bankers. The one thing that I would say is when talking to like a banker or an investor is anytime you're doing that, you're building confidence, and the question is going to be, how are you going to build that confidence? So bankers, you're going to be more looking at building financial statements, building maybe a slide deck that has all of your information in there. This had been helpful for me over the years. I have a PowerPoint presentation that if you were to say, pitch your company right now, and I'd probably say, give me 10 minutes because I need to go look at the slide deck and make sure my numbers are updated on it. But if the banker, or we've even done this with bringing in like consultants or like mentors, or you just want people to kind of have another set of eyes on your business, we'll say, hey, let's show you what we're about, and then ask us questions. And we want to know how to improve our business. So I keep a slide deck close at hand that I can pull up and say, okay, here's who we are. Basically, it starts off by, hey, here's our mission, vision, and values, has our key players, like, okay, here's Dave. It depends on, how intimate you are with some of the, like with a banker, I'll very, quickly have more numbers involved. Maybe if it's someone that I don't want to know the numbers, I'll just remove some of the numbers and customize it there. But then the big thing is I'll have trends. So what has happened last year? What happened the year before? I'll have graphs, and you can see, it's like, oh, okay, sales are going up. Well, that's good, right? What about profitability? Is profitability going? Well, here's that. So what's your contract flow? What are these things? So building this, this deck is very important for putting on a good presentation and being confident in what you're doing when you're explaining it to people. But bigger than that, I think it's the exercise. So it's a good exercise for you to just say, who am I? What are my trends? What numbers should I be tracking? And when you put them on paper and have someone else go, I don't know, that one didn't really mean that much to me. Well, okay, what does? Now it gives you the opportunity to ask questions to improve your slide deck, which gives you an opportunity to improve what you're building. So you're trying to build a better business as you go on. So if you can improve your numbers and improve the metrics that you're using, then you'll be better off. But the big thing I would say is knowing your numbers. It isn't just having the numbers, but you need to know them. So, or know what they mean. Do you understand that you are trending in a certain way, or that you do have money that is sitting idle because, well, your inventory is your inactive inventory or your idle inventory, whatever you're calling it. But do you know what that is sitting too long at a spot? And that's one of the nice things about a bank coming in. A bank is probably going to ask you harder questions than what the investor is going to. He's going to ask you to have reports. And I would say, know your reports. Build your reports. Show him what you have. He's probably going to ask you for more things, but that's fine. Build those reports. Track them regularly. Don't just build the report just to give it to the banker. Build the report so that you can build another report next quarter or next month, and so that you can start to see trend lines and see which direction you're going. They might ask you to do different things in different asset classes that you never really looked at, and they might make sure that you're putting certain non-performing assets in or out of that. And I guess where I'm going, they might even ask you to have audited financials, and you go to your accountant and say, what's it going to cost me to do audited financials? And he says $30,000, and you go, ooh, that's terrible. That's hard. I can't do that. But when you do, and when you do these things and are forced to do them, I call it they suck. It's like, it really sucks to try to have to go do them, but I just say embrace the suck. Like, just take it on, do it, and then look at what that will make you as you continue to build off of that. So when you take those hard things and build on them, you will be stronger in the end. If your banker wants numbers, get him the numbers, and rather than just passing them on and thinking they're his now, look at them, track them, learn from those. Same thing with your investor. If your investor wants information and asks you hard questions, answer them, dig down into them, because there's people we can learn from wherever they're at in our business. So that's what we're talking about, is then going out, and once you have built a lot of these things within your let's say your pitch deck or talking to investors, your biggest thing is to go out and be able to do it with confidence. And we were told about con men, weren't we? What are con men? They're confidence men. It's really what we are in the end. It shouldn't be throwing that one in there, but a con man is a confidence man. But really, in the end, that is what you're doing with any bank or any investor. You're trying to gain their confidence so that they trust you with their money. And so you need to do that well in crafting your pitch and then communicating this to the other people. Well, one of the things that we would have looked at was, let me back up here and making sure I had to cut 10 minutes out of my last presentation. Now I'm trying to put it back in, so we're getting there. So one of the things we're going to talk about is the building of relationships, and think about, like we talked about, what a banker might want. So he's going to be much more in the, I need P&L, I need balance sheet, I need those things. So, and those are those third-party verified things. Well, what about when you're going over to an investor? And investors are different. They're probably not as large a chunks, and they're much more relational oriented. And so, but we can still do things to continue to gain their confidence. And back in 2017, there was a couple of us, we were wanting to get into real estate. And so we took a Robert Kiyosaki course. And one of those, we went to a seminar. It was like a weekend seminar. And there was a speaker by the name of Michael Van Horn. And Michael Van Horn has given us all of the pitches and how we're going to, how you talk to investors and how you gain confidence and how you build relationships. And one of the things that he said was to pay your investors monthly. Don't accrue the interest. Don't have a $100,000 loan and then just say, oh, when your year is up, you'll have $107,000 and we'll pay you that back. Pay monthly. And he said, pay with a physical check and pay on time. Tell them you're going to do these things. So say what you're going to do and then do what you say. And so found my notes here now. So back in 2009, last time I said it was 2007, 2009, so that's quite a few years ago. So my brother Alan and I, we bought a 22-unit property that was probably a bit much for where we were at the time. We loaned like $600,000 from the bank. We get there and we're going to have to redo some heating and different things. Well, till winter rolled around, the heating wasn't working, and we needed $150,000 to really keep this property afloat. Well, the bank wasn't going to give us any more. So we went to a private investor, a friend of ours, and said, will you loan us $150,000? And he did. And that investor was of the class and caliber that it didn't matter if we accrued or not, like whether we sent him a check or not. It didn't matter to his lifestyle whether he even received this check or not. The interest was $875 a month. It wasn't going to change anything in his life. But yet we did it. So we would every month, my brother would walk over to his business, lay the check on his desk in an envelope, and because he was never there, he was busy, he's running around doing other things. He didn't have to sit and wait on this check. Well, one day, Alan walks in and hands him the check, and he gets the check, he reaches down, gets his letter opener, and kind of gets a grin on his face. And he said, I like opening up this check. And he looks at it, the whole $875 that we again said meant nothing to him, but yet it did. So we were building confidence that we are going to pay this. We're going to do what we said we're going to do. And we did. So in the end, that $150,000 that we borrowed from him, we paid that off. We sold the property. That story is long gone. But the confidence that we gained out of that now allow us to every year in a different company, which would be SmartPay, we now write him interest checks that are equal to $150,000 a year. So over time, with building patterns and doing what you say and build up, you will continue to gain confidence with investors, and they'll continue to trust you in a good and positive way as long as you continue to do those. So the moral of the story is looking at what matters inside of people's heads. So there is some psychology involved when you think about how you gain trust. But you want to think through it. It might be a little different for different investors, but you want to think through what they want, and then you want to say that you're going to do it, and then you want to do that, and that's ultimately how you're going to gain trust with people. You'll need to figure out how to work through objections, and they'll be common objections. You'll find that there's a theme with people that ask the same questions when they're objecting to it, but just learn what they are. Go do it again. If you fail on one, you try again on the next one. It isn't about that one investor who, if I could just land him, that's the one that's going to take my business to the next level. It's about continuing to pitch and finding out what the objections are and working forward from there. Various things that I would say are very different from the investor also are things such as you might have one investor who just wants you to say everything's going to be all right. You might have another investor who says, well, tell me more. Well, you might have to sit down and have lunch with the guy so that he is comfortable continuing on. You might have the other investor who's just tickled pink that at Christmas you give him a bottle of wine or, a pen or whatever it is, and his check comes in regularly. But that's really your job to figure out what every individual investor, again, it's now the downside to the investors because you got a whole bunch of them you got to figure out how to cater to instead of the banker just wants these big solid numbers. But finding that balance. Things like some investors want you to talk to them. Take the time, stop by. Something like a quarterly newsletter where you're just telling your story of how things are going. Are you still growing? Are you still profitable? Like, that doesn't always have to be done in a P&L, but it has to be done in a story, and they have to trust that you're telling a true story. And if they are, then you can continue to gain confidence. We are going to break into question and answer. Like I said, it's a lot of information that is just you figure out what you want to do with it. So what are the things that you guys are asking of yourself, or what are the things you wish I would have addressed? Good question. You might not. I would say the big thing is who your investor is or what base you're going towards. We've found that the people who are comfortable with fixed rate investor tend to be older people who are on a fixed income, and then at that point we're competing with CD rates and such. So if the person that is retired, has money in a CD, and now you're talking to that person, well, now you're comparing whatever your rate is, 7%, 9%, to them getting 4.5% to 5% at a bank. Then you have less of those objections. But if you go over, I agree, if you go over to the guy who's out there playing the stock market or flipping houses and whatever, he's going to be a tough sell for you to just say, unless he's ready to move there, until he's ready to move there. So I'm not sure what that answers it, but I think if you're running into that too much, I would focus on shifting where I go for the ask. Other questions? Yeah.
So a couple of questions I worked through, and so I wonder how you answer them is, do you provide us with a P&L, and how risky is this investment? So what's your pet answers for those two?
We do not, with investors, provide P&L. We're not required to, the way we write our private placement memorandum. But I would say it depends on the investor. The last class, somebody asked someone and said that guy is trying to put $50,000 in, is asking me way more questions than the guy, the larger amount. And I say, well, I will actually weigh it pretty much. If it's a large investor, I'm going to cater to more numbers. We're not required to do the P&L, but I'll be more open in that way with someone I would say deserves more, if that's the right. What was the second part of it?
So then that question that it tends to be the lower number of people ask is, how risky is this, Mr. Tanner?
Yeah, and I would say that's one of those objections that I said, as you soon learn to craft some of those things. I would say one of those is what's going to happen if the economy turns down. The way I tend to explain that is, with the way rent-own works, is we're catering to a certain income level of people. And as the economy goes up or down, and that group of people might have less money, but there's always a group above or below that would not have been using this product. So I'll be straightforward and say, no, I don't like the economy going down, but it's not going to kill my business for a couple reasons. One is, yes, we're going to have more turnover, because when you shift these classes or these income levels, then you're going to have more returns. We don't like returns. We don't make as much money on returns. But when it shifts, there's always another one there, so there'll be a continued flow of contracts, maybe less, but it's not just dropping off just because we now lost that. The other, I would say, is the beauty of rent-own is everything is short-term. So our cash returns very quickly, unlike doing a 30-year mortgage where you're saying if something tanks, you can be underwater for a long time. This thing self-liquidates very quickly with the cash coming in, so you don't have these longer-term problems. There are two ways that I would quickly answer that, but it may not have been what that person wanted, so you're going to have to cater to that. Okay, well, thank you guys.